Hello, I'm Naganath, President and Chief Investment Officer of DSP BlackRock Investment Managers. Let me begin by wishing you all a very happy and prosperous New Year. Over the next few minutes, I would like to present our outlook for the global economy and also for the Indian economy. So let's start with the global economy. First, we'll take a look at the American economy. More recently, early this month, we saw the negotiations about the fiscal cliff, which were resolved early part of January. In the next 4 to 6 weeks, you will see more negotiations, this time around the debt ceiling limit. These negotiations, we believe, will be somewhat protracted over a 4 to 6 week period till the end of February. That will contribute to higher volatility in global markets. But eventually, we believe that the debt ceiling limit will be increased, and thereafter we see the economic recovery momentum in the US gathering pace into the later months of 2013. As far as the Eurozone crisis is concerned, for the moment it appears to have subsided. However, there will be points in time later this year when the crisis could likely re-emerge, at which point again global markets will see higher volatility. But for now, the good news is that the Eurozone crisis for the moment seems to have subsided. If you look at Asia, growth in China will somewhat moderate, but not too much. Likewise in Japan, where markets have done very well in the last few months, we're likely to see more quantitative easing and economic stimulus accelerate economic growth there in the months ahead in 2013. So broadly, that's the outlook for the global economy as we see it today for the remainder of this year. Let's now turn to what the outlook is for the Indian economy for this year. Now for fiscal 13 ending in March 2013, the expectations for GDP growth are in the range of about 5.5% to 5.6%. We think this rate of GDP growth will accelerate in fiscal 14, which is April 13 to March 2014, to a rate of about 6.5% on the back of higher consumption demand, on the back of a renewal of the investment spending cycle, and that we believe will take us to about 6.5% GDP growth rate. We think that in the years thereafter, investment spending by the private sector will accelerate and could likely take the rate of GDP growth to 7% or higher in fiscal 15 and fiscal 16. But turning back to fiscal 14, which is a financial year just ahead of us, at 6.5% rate of growth for GDP, we think corporate earnings in India will grow around 15%. For fiscal 13, that number was in the range of 10 to 11%, so it will be an improvement at 15% rate of growth. Thereafter, in the years that follow, we think earnings growth could well accelerate to the 18 to 20% mark if GDP growth rate gets to the 7% plus rate of growth. Therefore, when you look at a 15% rate of corporate earnings growth for fiscal 14, a GDP growth rate that we think will be in the range of about 6.5%, that will underpin strong performance by Indian equities, which are currently trading at about 14 times PE multiple for fiscal 14. And that's why we feel very bullish about Indian equities in 2013 and as you look at the financial year in fiscal 14. Therefore, may I wish you all the very best for 2013 and look forward to speaking to you again sometime later this year with another update on our outlook for the global economy and for the Indian economy. Thank you again for your patient listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.